Welcome back. Canadians may be less worried about a recession now than a few months ago, but is it time to start fretting again? Here's a look by the numbers. First, growth in Canada is lackluster at 1% in the fall quarter. That was below the Bank of Canada's expectations and down from 2.2% the quarter previous. It's also the sixth consecutive quarter of shrinking growth per person in Canada. That's 18 months in a row. That could explain why things feel bad to many people. Household savings did rise to 7.1% as incomes climbed faster than spending. That's more than double the pre-pandemic savings rate. But households may also be holding off on spending ahead of mortgage renewals. 4 million mortgages will renew in the next 2 years. That's 60% of outstanding mortgages. Of course, interest rates have come down. The Bank of Canada's rate is now 3.75%. Expectations are the bank will keep lowering next week. A recent Ipsos survey conducted for Investors Group showed nearly half of consumers believe Canada is in a recession now. That's down nearly 60% from a year prior. 54% think we will see a recession in 2025. Almost 7 in 10 said they think the economy is still weak. 63% said authorities don't have the situation under control. Growth overall, of course, is slowing, and the job market seems weaker, of course, than a year ago. So are Canadians right to feel pessimistic? Charles St-Arnaud is chief economist at Alberta Central. Thanks for being with us, Charles.
Good afternoon.
So we definitely have these data points that say actually things are kind of weak. But do you think people's confidence or pessimism is not matching up the data? In other words, do people think it's worse than it is?
I think we need to kind of look under the hood of the data. So yes, overall growth in Canada is still positive. It's not very strong as we saw in the third quarter. About 1% growth is relatively weak. But when we start looking deeper, we look at consumption per capita is still very weak. Disposable income per capita is also very weak. Actually, we're only marginally above levels we were pre-pandemic, and we're well below level we should be if disposable income have continued to increase at the same pace it was pre-pandemic. So households actually feel that they're falling behind.
And of course, there's kind of a slow moving piece of that trend, right? Because of our productivity, we have seen a kind of an intergenerational shift in wealth accumulation. It's harder to be young now than it was 20, 30 years ago. Is that sort of the overlay on top of all of this?
Yeah, I think there's two also distributional issues there. Is that when we look at between income cohorts, obviously those who are making less income have been more affected by higher grocery prices, higher shelter prices, so they've seen a bigger hit on their purchasing power. They've also been hit a bit more by the higher interest rates, while on the higher income side, they've been benefiting from higher housing prices and also the continued increase in stock valuation. And the same is also true for when we look at generations. The younger generation tends to be more indebted, so they're seeing more hit from higher interest rates, while the older generation is benefiting from, again, house price appreciation and higher stock prices.
I think you only have to look at the way the number was revised for all of last year to kind of get a sense that the GDP number is a bit of a blunt instrument, and it's sort of removed from most people's daily understanding, Charles, of how they're doing and how the economy is doing. What do you think is a data point? What do you watch to say this is how people might be feeling, that they're feeling better off? Is it wages rising? Is it household prices? What's the key metric you might watch?
Yeah, for me, the main metric I've been watching over the past few years has been really disposable income adjusted for inflation. So basically looking after tax, how much households are bringing back home and adjusted for inflation to see how their purchasing power has been evolving in recent year. And it's looking like it's been underperforming significantly. Like I said, we're 5% below where we should be. So it's not. So there's a reason why households are not feeling positive about the economy.
And what would change that? I mean, obviously, after-tax income, is it wage growth that we need to see? What would set that right?
Well, that's the thing, is that part of it is we need probably higher income, yes, but it's also there's still an adjustment from the high inflation that we've had in 2022, 2023. And that will take time. So yes, inflation is back at the Bank of Canada's target, but price level are still significantly higher than they were in 2019. And that will take some time to adjust. And without decent productivity gains, it will be hard to justify higher wages too.
Is there a government policy that you would favor to try to juice the economy?
Well, at the moment, it's clear that we have a lot of challenges in the economy, and it's all we need a holistic approach to productivity. So it's not just we need to help affordability, or we need to look at every aspect of it. And one of them is really trying to target why businesses are not investing right now, why we're seeing such an underperformance in investment by Canadian businesses in machinery and equipment, in intellectual property, in research and development. And that is really the root of our productivity.
Charles, so good to have you for this. Appreciate your time.
Thank you for having me.
Charles St-Arnaud is chief economist at Alberta Central. One place economic pessimism has shown up is in business investment. Now, Canada's manufacturers have new reasons to feel gloomy. Does that doom mean any new investment might not happen? Dennis Darby is president and CEO of the Canadian Manufacturers and Exporters. Dennis, thanks for being with us.
Hello, Amanda. How are you?
Well, I'm okay. I'm worried about our manufacturers. The data from November was actually pretty good. We saw an uptick in activity for the first time in months, and yet we now have this specter of potential tariffs looming over the whole sector. What's your take on the health of your members?
Well, first of all, you're right. I mean, it has been a relatively bumpy and slow recovery. Mostly fueled by great demand in the U.S. And so for manufacturers across Canada, the last thing they needed to hear was the threat of a tariff, especially at the level that we heard, at this point in the year. And I think that's probably got everyone concerned, and certainly should have our American counterparts concerned, because, of course, a tariff will inevitably cause inflation and higher input costs for American manufacturers, and as it will for Canada, because we trade so much back and forth.
Yeah, and I guess the uncertainty factor is something we've seen in the last Trump presidency. We saw a lot of businesses sitting on their money. They didn't want to invest because they didn't know what was going to happen. Is there a fear that that might happen again, that much needed investment in plant and equipment won't happen again because of the unknown?
Well, yes, anecdotally, we haven't polled our members, but we will be next week. But what we've heard anecdotally from companies big and small, and it really ranges. And you're right, it's like back in 2017. A lot of companies are sitting on their hands on any incremental investment, new business plans or new expansions. We've heard companies talking about holding off on any hiring that they would need to do, wait and see. Some companies, where they can, are trying to either pre-sell stuff into the U.S. and in some cases also try to get goods or parts and ingredients from places like China, which will have could have a tariff on them as well. So generally, it's the uncertainty, and so companies are doing what they need to do and they can do. Often they don't have a lot of extra capacity, whether it's in warehousing or production, but kind of wait and see, and that's not good. That's not good for the sector, and it's certainly not good for our trade with the U.S. And I think it will have an effect on the U.S. as well. And that's the work we've been doing, working with our American counterparts in the manufacturing associations in the States, because this threat is causing a bit of a chill on everybody, and it will have a negative effect if it goes ahead. So the best thing for us is we can avoid it. But right now, people are planning as if something will happen.
We do have this kind of strange disconnect between how a lot of households are feeling, which is that they feel gloomy. They feel as though there may even be in a recession now. And then the kind of headline data, including from your sector, right? The manufacturers are showing signs of life. Things actually look pretty good. As you say, the U.S. economy is good. Should we be more optimistic? Is this a time maybe to lean into the optimism that there could be expansion ahead?
Well, I'm not sure, and that's because of the tariffs. I would have said, absent the threat of tariffs, I think this is a time Canada really does need to step up its investment. As you've said before, we've lagged on investment, which means lagging productivity, because we're not using the best tools, the best technology. So normally I would say, this is the time for companies to start investing. We've seen some of that, but I can say in the recent week or so, people are at least giving it a second look. So it's the more important than ever that we get this resolved, or we get more clarity. And certainly that's the work we're doing, and I'm certain that's the work governments are doing as well.
All right, we'll be watching for that. Dennis, thanks so much for your time today.
Take care.
Dennis Darby, President and CEO of the Canadian Manufacturers and Exporters. Coming up, governments mired in deficits still have to invest in infrastructure, don't they? That's still ahead. But first, diamond producer De Beers is dropping its prices a whopping 10%, one of the biggest such sales in memory. The South African diamond marketer has come a long way from the days when it controlled almost 90% of the globe's supply of the shiny rocks, with new players in Canada, Russia, and Australia undercutting their control. And now, lab-made gems are upending the profit dynamic of a business that was always built more on hopes and dreams than reality. We're back after this.